it's the end of the world. Not. In the first week and a half of October, we've clearly moved into a financial panic. We've gone from a situation where people didn't know what things were worth, so they sold, to a situation where people don't care what things are worth, so they're selling. Well, think about what happens when the end of the world doesn't come. People go, oh, gee, well, I'm still here. Maybe I ought to buy some of the stuff that I was selling at such stupidly low prices only 2 weeks ago. The problem, of course, is telling when the end of the world is supposed to come and when it doesn't arrive. You really need to know when the spaceships are supposed to arrive and take everybody away from the mountaintop, because otherwise you really don't know when it's all over. Well, I've actually got some dates in mind that would let you try to figure out when the end of the world is supposed to arrive. The big event, the one that's got all the world's biggest financial institutions running in fear and selling anything they can so they can raise cash, concerns Lehman Brothers. You remember Lehman Brothers went bankrupt. The Fed decided not to bail them out. Well, Lehman was a huge player in the derivatives market. They had about $400 billion of derivatives that they were involved in. Well, these now all have to be unwound. Now, in a normal market, and one in which Lehman didn't go bankrupt, this $400 billion would be settled pretty much evenly. There wouldn't be a whole lot of winners and losers, net. But this isn't a normal market, and Lehman is in bankruptcy. What that means is that all of the institutions that owe Lehman money, they took out a derivative that involved having to pay Lehman if certain things happened. Well, you know what? They're not going to pay. They're going to do everything they can to make sure they don't have to settle. And what that means is the people on the other end, the people who are supposed to collect from Lehman when certain things happened. Remember, these derivatives sort of work like an insurance policy. Well, there's not going to be a whole lot to collect. Now, when Fannie Mae and Freddie Mac settled up their derivative book, which was even bigger, about $500 billion, the damage was really pretty small because the Treasury and the Fed had stepped in to stand behind the Fannie Mae and the Freddie Mac bonds. So really, most of the people in this deal got somewhere between 91 and $1 back on every dollar. Not a big deal. But Lehman's bonds are now trading, to the degree that they trade at all, at about 10 cents on the dollar. So if you think about that, it means that there's a good chance that this $400 billion worth of derivatives, when it's all settled, is going to produce a $360 billion loss. But no one knows who's going to take the brunt of this loss, which is why so many people are raising cash, because you certainly don't want the settlement of the Lehman Brothers derivatives book to mean that your institution is being pushed into bankruptcy, insolvency, or something else just really as bad. So what you've got is a situation where everybody's been selling with the idea that no one knows what's going to happen. Well, the book is being settled now. The book starts to be settled on around October 10th. It's probably all going to be pretty much over, as in the sense everyone will know what they owe or what they're going to collect by about October 23rd. If October 23rd comes and the world comes to an end, well, the panic has been absolutely justified and, in fact, hasn't been enough. We all should be out there buying ammo right now rather than worrying about how to protect our portfolios. But if the world doesn't end on October 23rd, if all these institutions suddenly go, oh, now I know how much I owe, and it's a reasonable amount of money, or it's even an unreasonable amount of money, but at least I know what it is, I can start maybe buying a few things, or at least I don't have to sell at fire sale prices. The market starts to stabilize. And what we could see in the days after October 23rd, when the world doesn't come to an end, is a very typical bear market rally. These are very, very sharp. They go up really, really fast. 20, 25%, even 30% is pretty much normal for one of these. They don't last long. They don't necessarily put in a turn in the market because, after all, think about it. You're probably sitting there with all these things that you'd like to sell if you got a 25% rally. So rallies usually fail at this point. But I think we're looking at something like a rally. We're looking at something like the end of the panic toward the end of October. This happens to correspond with when the market usually turns after the 2 bad months of September and October. So really the timing would be pretty good. People are sort of expecting this. They're sort of hoping for it. And when there's hope for something, you get a kind of crowd mentality on Wall Street. And this would just be a crowd mentality looking for things to go up as opposed to the current crowd, which is looking for everything to go down to zero. This is Jim Jubeck for MSN Money.